Now, in this chapter, we look at how to draw up a balance sheet. Balance sheet is, we had looked into balance sheet in the first chapter as well. And after the last chapter, in which we came up with a net profit figure by preparing a trading and profit and loss account, we had balances remaining, which are only assets, liabilities, and capital. Now, so the balance sheet would only contain details of assets, liabilities, and capital. So all those accounts of income and expenses which were not included in the trading and profit and loss account are included in the balance sheet. How do we draw up a balance sheet? So after we had finished preparing a trading and profit and loss account, we came up with a trial balance, which is a list of balances. We can find that there are a few balances which only relate to assets and liabilities. So we will use these balances to plot a balance sheet. Now we look at a sample balance sheet format and generally how the balance sheet is prepared. So the balance sheet would then be divided into a section of assets. So we plot all assets under the assets section. So fixtures and fittings, debtors, stock, bank, and cash, we'll list them down under assets, and then we'll plot their figures, and then we would have a total of the assets. Then what we'll do is we'll subtract liabilities from this asset to find out what our capital would be. So when we subtract our liabilities, which would be our creditors, which is here 9,100, we'll subtract it from our assets and we'll come up with a figure which would be equal to the capital of the owner. So this means that for an owner, it would mean that whatever the business has in uh, as an asset, whatever the business owns, subtracting whatever amount they have to pay to outsiders, the remaining amount, whatever is in the business, is owned by the owner, which means that the business owes this amount to the owner. All that item amount of 21,000 belongs to the owner. So that's why we have a capital figure and then we have an assets minus liabilities section. And no double entry in balance sheet. By this, it means that when we were drawing up trading and profit and loss account, we had a few closing offs to do and we were transferring amounts from one account to another. However, in balance sheet, we didn't do anything or like that. We just plotted the balances as it is. One of the reasons because of this is that trial balance and balance sheet, they are just simply list of debits and credits arranged. So we are not closing off any accounts, we're not transferring any accounts to different accounts, we're just arranging them to find out our balances. These accounts are would stay as it is and the balance would then move on to the next period. So the accounts are not so these accounts of assets and liabilities and capital, they are not being transferred to any separate account. They will remain in their account and carry forward to the next period. So that's why when we are preparing trial balance and balance sheet, we would just list down the balances and we will not be having double entry or any journal entries or T accounts to prepare that. Now we'll look more at the balance sheet layout. So we found out that the way we divide as balance sheet would be in assets, liabilities, and capital. So the best way would be to would be assets minus liabilities is equal to capital. Whenever we are adding the balances under assets, we could either do it haphazardly, which would be in any random format. We could have the cash on top, and then we could have debtors, and then fixed assets, and then maybe bank. But whenever a person is looking, it would get very much confusing for them to kind of like understand which sort of assets they are. So there is a specific way of arranging different assets. So there are generally two types of assets. One is the fixed asset. Fixed assets are assets which were not bought primarily to be sold, but they were bought to be used in the business. They are to be used in the business and are expected to be of use to the business for a long time. So the three features that a fixed asset would have would be not bought to be sold, expected to be used in the business and to be used for a long period of time, not for like a few months. So examples of these would be building, machinery, motor vehicles, fixtures, and fittings. And then based on these, we will arrange all of these assets based on how long they're expected to be used. So, like land and buildings, they are expected to be used for a very, very long time compared to fixtures and fittings or machinery or even motor vehicles. Like motor vehicles have the shortest life in within the fixed assets category, because after 3, 4, or 5 years, we could expect them their value to go down significantly, and some of them might not even be rendered useful. So this is generally how the layout of fixed assets is. So whenever from the trial balance you have different lists of different assets written down, you should try to always use this arrangement to list them down in accordance to their length of time, and also the value as well, because generally land and buildings would cost much higher than motor vehicles. The second category of assets is current assets. As the name suggests, the current assets are for very short period of time, and they are likely to change in short time, and definitely or certainly within 12 months of the balance sheet date. So uh, as for fixed assets, like if you have a building or a motor vehicle, we wouldn't expect them to kind of like replace them within 12 months. It could be like even 5 years or 10 years. But for current assets, we could expect them to kind of like turn over, turn around, or be replaced within a year. Examples of these are stock, debtors, cash at bank, and cash in hand. Now, based on how easily they can uh, change into another item, or they would be sold, or resold or turned into cash, we would then try to arrange it. Cash in hand is the easiest, like we have cash actually in hand. So, and we can change hand anytime. Cash at bank is also easy to change, but we'll have to either go to the bank, or if it's a check, it could take 3 days to process. So it is not as easy to change hands as cash in hand would be. Debtors is the amount that the debtors would owe to us, and they would pay to us. So it is like we could get them cash, but it's going to be like less readily available than if we have the cash in our hand or cash in bank account. And the last would be stock. Stock is items that you would sell. So if you were to need cash urgently, stock would take some more time than the debtors to kind of like sell and get money. So that's why this is the list of how we would place these items in a balance sheet. So first would be stock, debtors, cash at bank, and cash at hand. I really advise you to sort of completely understand why uh, we have this way of presenting the current assets, and to kind of like even sort of know it by this stage which items would go first and which items would go less, so that when you are in the exam you do not waste much time thinking of where to put the items. So this was the different categories of assets, fixed assets and current assets. We'll move on to liabilities. Liabilities is anything that we owe to other parties. Now these again can be divided into two categories: current liabilities and long-term liabilities. Current liabilities have a similar criteria to current assets, which means they would turn around, or they have to be paid within a year of the balance sheet date. So very common examples would be bank overdrafts. These are very short-term loans from the bank, which we have to pay within a month or within 12 months. Amount due to creditors from purchase of goods for resale. So creditors. So in this way, creditors would always go on top, and bank overdrafts could go at the bottom, because bank overdrafts will have to be repaid much quicker than creditors. So that would be the way they would be put down. In terms of long term liabilities are all those amounts which have to be paid more than a year after the balance sheet date. Examples are bank loans and loans from other businesses. Now, one thing you should keep in mind that some bank loans which have to be repaid within a year, can also be classified into current liabilities. So here we now, after looking at the different categories, to we will come here to a balance sheet where we would write all the different categories of assets and liabilities as well. So fixed assets, we will segregate fixed assets and current assets. Fixed assets will have a total. In current assets, we would have a subtotal, and we would add it here, and then less current liabilities of creditors. which would be subtracted from current assets, and a difference would then be added.